There is a metal that runs through nearly every modern technology you use. It sits inside your smartphone. It lines the solar panels spreading across rooftops in Arizona, Germany, and Britain. It powers the circuits in defense systems that governments do not like to discuss publicly. And right now, in 2026, there is simply not enough of it. Silver is trading above $70 an ounce. But here is the part that should concern you. This is not a speculative bubble. This is not retail traders piling into a shiny object because someone on the internet told them to. This is something far more structural, something that has been building quietly for half a decade, while most investors were watching Bitcoin, meme stocks, and the latest artificial intelligence craze. Silver has now entered its 5th consecutive year of supply deficit. In any other market, for any other commodity, this would have triggered a repricing years ago. But silver is not like other commodities. It exists in a strange middle ground between industrial metal and monetary asset, and that dual identity has kept its true value suppressed longer than most analysts predicted. That suppression is now ending, and the consequences will ripple through energy policy, technology supply chains, and the balance sheets of nations that did not prepare in time. To understand what is happening with silver in 2026, you first need to understand what a structural deficit actually means. Because this is not a temporary imbalance. This is a fundamental mismatch between how much silver the world needs and how much the world can actually produce. Every year, the Silver Institute publishes data on global supply and demand. And for 5 years running, that data has told the same story. Demand has exceeded supply, not by small margins, but by significant volumes. In 2024, the deficit exceeded 200 million ounces. In 2025, it grew larger still. And now, in 2026, forecasts suggest mine production will actually decline, even as demand continues its relentless climb. This is not supposed to happen. In traditional commodity markets, rising prices attract more investment into production. Miners expand operations, new projects come online. Supply eventually catches up with demand. But silver does not work that way. And the reasons why reveal something important about how modern commodity markets actually function. Most silver is not mined from primary silver deposits. It comes as a byproduct of mining other metals, primarily copper, zinc, and lead. When copper prices are high, mines expand copper production, and silver supply increases as a side effect. But when copper investment stalls, so does silver output. There are very few pure silver mines in the world, and the economics of developing new ones are brutal. It takes a decade to bring a major silver project from discovery to production. Permitting alone can consume years. And capital has been scarce for junior mining companies ever since interest rates began their climb in 2022. So even though silver prices have risen dramatically, the supply response has been almost non-existent. The mines that exist are producing at capacity. The mines that do not exist cannot be built fast enough. And the silver that was once stockpiled in exchange vaults and industrial warehouses has been steadily drained. This is the first piece of the puzzle. Supply is constrained by factors that price alone cannot easily fix. The second piece is demand, and this is where the story becomes far more interesting. For most of the 20th century, silver demand was dominated by photography. Film required silver halide crystals, and Kodak was one of the largest industrial consumers of silver on the planet. When digital photography destroyed that market, many analysts expected silver demand to collapse. It did not. Instead, something unexpected happened. New applications emerged, and those applications turned out to require more silver than photography ever did. Today, the largest single driver of industrial silver demand is photovoltaics, solar panels. Every solar cell contains silver paste that forms the conductive pathways allowing electricity to flow. A single residential rooftop installation might use half an ounce of silver. A utility-scale solar farm can consume hundreds of thousands of ounces. And in 2026, solar capacity is expanding at a rate that would have seemed impossible a decade ago. China installed more solar capacity last year than existed in the entire world in 2015. The United States, driven by Inflation Reduction Act subsidies and accelerating corporate procurement, added over 40 gigawatts of new solar in 2025 alone. And Germany, which we will discuss in more detail shortly, is in the midst of an energy transformation that is consuming silver at extraordinary volumes. But solar is not the only demand driver. There is another technology category that is quietly becoming a major silver consumer: artificial intelligence. The data centers required to train and run large language models consume staggering amounts of electricity. That electricity must be distributed efficiently, which requires conductive materials. Silver is the most conductive metal on Earth. Better than copper, better than gold. In high-performance computing applications where efficiency is critical, silver is increasingly the material of choice. The servers powering AI systems also require silver in their semiconductors, their switches, their connectors, and their thermal management systems. Every new data center that comes online to support the AI economy represents incremental silver demand. And in 2026, there are hundreds of such facilities under construction across the United States, Europe, and Asia. Then there is electric vehicle production. Every EV contains between half an ounce and 2 ounces of silver, depending on the model. As global EV sales continue growing, so does silver demand from the automotive sector. Add it all together: solar, AI, electric vehicles, consumer electronics, medical devices, water purification, and you get a demand profile that is growing faster than any historical precedent. And unlike gold, where jewelry and investment absorb most production, more than half of all silver demand comes from industrial applications where there is no substitute. You cannot run a solar panel on copper paste. The physics do not work. This creates a situation that is almost unprecedented in commodity markets. Demand is growing structurally, supply is constrained structurally, and the inventory buffers that once existed have been depleted. The response from major governments has been revealing. Because when nations start treating a commodity as strategic, it tells you something about how they view the future. In the United States, the Department of the Interior added silver to its list of critical minerals in late 2024. This was not a symbolic gesture. The critical mineral designation unlocks federal support for domestic production, streamlines permitting for mining projects, and signals to defense contractors that the Pentagon is paying attention. The United States military consumes silver in ways that rarely make headlines. Tomahawk cruise missiles contain silver components. So do satellites, radar systems, and secure communications equipment. The defense industrial base requires reliable access to silver, and that access is increasingly threatened by global shortages. The critical mineral designation has triggered a scramble to assess domestic stockpiles. Unlike oil, which the United States stores in massive strategic petroleum reserves, silver has never had an equivalent government buffer. What stockpiles exist are held privately, in exchange warehouses and industrial inventories. And those private stockpiles have been shrinking for years. There is now quiet discussion in Washington about establishing a strategic silver reserve. The logistics are complex. Acquiring hundreds of millions of ounces without disrupting the market would be nearly impossible. But the very fact that such discussions are happening tells you how seriously policymakers are taking the supply situation. Meanwhile, tariff policy has added another layer of uncertainty. The current administration's approach to trade has created volatility in base metal markets, including copper, which directly affects silver supply through the byproduct dynamic described earlier. If copper projects are delayed due to trade tensions, silver supply will suffer as a consequence. The interconnections are subtle but powerful. Across the Atlantic, Germany is confronting the silver deficit from a different angle. The country's Energiewende, its energy transition, has entered a critical phase. Following the cutoff of Russian natural gas and the political decision to phase out nuclear power, Germany is betting heavily on renewable electricity generation. And in practical terms, that means solar. Germany's solar ambitions for 2026 and beyond are extraordinary. The government has set targets requiring the addition of tens of gigawatts of new solar capacity annually. Rooftops, farmland, commercial buildings, and industrial facilities are being covered with photovoltaic panels. Each of those panels requires silver. But Germany does not mine silver. It does not have significant domestic deposits. Every ounce must be imported, primarily from Mexico, Peru, and increasingly from recycling streams. And in a market where global supply is already below demand, securing those imports is becoming more difficult and more expensive. German industrial firms, particularly in the electronics and automotive sectors, are now competing directly with Chinese solar manufacturers for limited silver supplies. This competition has pushed procurement departments to negotiate multi-year supply contracts at fixed prices, a strategy that locks in today's costs but reduces flexibility. Some firms are reportedly stockpiling silver inventory as a hedge against future shortages. The strategic implications are significant. Germany's energy security now depends, in part, on its ability to secure consistent access to a metal that it cannot produce domestically. This creates vulnerability. It ties German energy policy to the decisions of mining companies in Latin America and refining operations in Asia. It introduces a new variable into the complex equation of European power politics. And it highlights a truth that many policymakers are only now beginning to internalize. The green energy transition is not simply a shift from fossil fuels to renewables. It is a shift from energy dependence to materials dependence. The constraints are different, but they are no less real. The United Kingdom faces its own version of this challenge, though the emphasis differs. British silver demand is concentrated in two sectors that are both strategically important and difficult to scale down: electronics and defense. The UK electronics industry, while smaller than its Asian competitors, still manufactures high-value components for telecommunications, aerospace, and medical devices. Silver is essential for these applications. Its conductivity, antibacterial properties, and resistance to corrosion make it irreplaceable in certain circuits and connections. More significantly, the UK defense sector relies on silver for applications that are classified but can be inferred from public procurement data. Surface-to-air missiles, naval systems, encrypted communications equipment, and satellite components all require silver in their manufacture. And the Ministry of Defense, like its American counterpart, is growing increasingly concerned about supply chain security. Brexit has complicated Britain's position. Outside the European Union's common procurement frameworks, the UK must negotiate its own supply agreements with mining nations and refining centers. This creates administrative burden and reduces leverage in a market where major buyers like China, Japan, and Germany command attention. The British government has not yet designated silver as a critical mineral with the same formal status as the United States. But the policy discussions are moving in that direction. There is growing recognition in Whitehall that the materials required for national security cannot be left entirely to market forces. So who benefits from the silver deficit and who loses? The obvious winners are those who already own silver. Mining companies with producing assets are generating exceptional cash flows. Investors who accumulated physical silver or silver-linked instruments during the years of low prices are seeing substantial returns. Nations with domestic silver production, particularly Mexico and Peru, are earning increased export revenues. But the benefits are not evenly distributed. Junior mining companies, despite the higher silver price, often cannot access the capital needed to develop new projects. Interest rates remain elevated, equity markets are skeptical of mining investments, and the timeline to bring new production online is so long that many projects cannot attract financing even at current price levels. This creates a peculiar dynamic. The silver price is rising, investment returns are improving, but actual supply growth remains minimal. The capital markets that should be directing resources toward solving the shortage are instead holding back, waiting for conditions that may not materialize for years. The losers are industrial consumers who must either absorb higher input costs or find ways to reduce silver content in their products. Some manufacturers are investing in research to develop silver-free alternatives. Others are simply passing costs through to customers. Solar panel prices, which had been falling steadily for years, have stabilized as silver costs offset gains in efficiency and manufacturing scale. There is also a class of losers that is less visible but equally important. Nations that delayed their energy transition planning and must now compete for scarce materials at elevated prices. Countries that bet on natural gas as a transition fuel, only to see that supply disrupted, are now racing to build out renewables without the lead time to secure favorable material contracts. They are paying premium prices for silver, lithium, copper, and other essential commodities, straining budgets that are already stressed by inflation and debt service. The incentive structure is clear. Early movers in the energy transition secured their material supply at lower costs. Latecomers are paying the price of hesitation. But here is what most observers miss about the silver deficit. It is not simply a supply and demand imbalance that will eventually correct. It reveals something deeper about how modern economies manage critical resources. For decades, the implicit assumption was that commodity markets would solve allocation problems automatically. Prices would rise, supply would respond, and equilibrium would be restored. This worked reasonably well for oil, for natural gas, for agricultural commodities. But it does not work well for metals like silver, where supply is geologically constrained and byproduct dependent. The silver market is also distorted by the metal's dual identity. As both an industrial commodity and a monetary asset, silver attracts speculative interest that can decouple price from physical fundamentals. The paper silver market, where derivative contracts trade in volumes far exceeding physical supply, creates price signals that do not always reflect the true scarcity in the physical market. Large financial institutions can take short positions in silver futures that temporarily suppress prices, making it harder for mining companies to justify expansion investment. Meanwhile, physical silver flows from exchange warehouses to private vaults, disappearing from the visible supply that analysts track. This disconnect between paper and physical markets is not new, but it becomes more significant when physical supply is genuinely constrained. At some point, the abstraction breaks down. Someone needs actual metal, and the metal is not there. When that happens, price discovery becomes violent and sudden. There are signs that this process is already underway. Registered silver inventories at major exchanges have been declining for years. Premiums on physical silver coins and bars have risen far above nominal spot prices. Industrial buyers report longer lead times and tighter availability from refiners. These are the symptoms of a market under stress. The deeper structural issue is that there is no mechanism to ensure that silver goes to its highest value uses. The solar panel manufacturer, the missile contractor, the smartphone assembler, and the retail coin investor all compete for the same finite supply. There is no allocation system, there is only price. And price is a blunt instrument. It cannot distinguish between essential and optional demand. It cannot prioritize national security over consumer electronics. It simply rations supply to whoever is willing and able to pay the most at any given moment. Some governments are beginning to recognize this limitation. The strategic stockpiling discussions in Washington, the critical mineral frameworks in London and Berlin, the export restrictions emerging in producing nations. These are all attempts to override pure market allocation with policy intervention. Whether such interventions will be effective or whether they will simply create new distortions remains to be seen. There is also a monetary dimension to the silver story that deserves attention. Throughout human history, silver functioned as money. It was the backbone of monetary systems from ancient Rome to the 19th century United States. The dollar itself was originally defined as a specific weight of silver. When governments moved to fiat currency, silver lost its official monetary role, but retained its psychological status as a store of value. In periods of monetary instability, investors return to silver. They buy physical metal as a hedge against currency debasement, inflation, or systemic financial risk. This investment demand is distinct from industrial demand, and it can surge unpredictably based on macroeconomic sentiment. In 2026, that sentiment is shifting. Inflation has proven more persistent than central banks expected. Debt levels in major economies are historically elevated. The dollar's dominance as a global reserve currency is being questioned, albeit slowly, by nations seeking alternatives. These conditions create fertile ground for increased silver investment demand. If that demand materializes at scale, on top of already elevated industrial demand, the silver deficit could widen dramatically. There is no additional supply to meet a sudden investment surge. The metal simply does not exist in sufficient quantity. This is the scenario that some analysts whisper about privately, but rarely discuss publicly. A convergence of industrial and investment demand in a market with depleted inventories and constrained production. The mathematics suggest prices that would seem fantastical by recent historical standards. Whether such a scenario unfolds depends on factors that are inherently uncertain. Macroeconomic conditions, investor psychology, geopolitical stability, technological substitution. Each variable introduces risk that cannot be precisely quantified. But the structural foundation for such an outcome is already in place. The deficit is real. The inventories are depleted. The production response is absent. What remains is simply a question of when and how rapidly the market recognizes what the fundamentals have been signaling for years. Standing back from the details, the silver story of 2026 is really a story about preparation and its absence. It is about the difference between nations and institutions that understood the material's intensity of the energy transition and those that assumed such details would sort themselves out. The green economy was never going to be dematerialized. It requires vast quantities of physical stuff. Copper for wiring, lithium for batteries, rare earths for magnets, and silver, more silver than anyone fully anticipated, for the solar panels and electronics that make it all work. Those who secured their supply chains early are now in positions of advantage. Those who did not are scrambling, paying premium prices, and confronting strategic vulnerabilities they did not anticipate. This is not a critique. It is simply an observation about how incentives work when resource constraints bind. The market punishes late movers. It rewards those who see scarcity coming and act accordingly. For individuals watching this unfold, the implications are similar. The time to position for a shortage is before the shortage becomes obvious. By the time headlines announce a crisis, prices have already moved and opportunities have already closed. Silver is not unique in this respect. The same logic applies to any resource that is essential, finite, and structurally undersupplied. The only difference is the timing and the severity of the eventual repricing. In the case of silver, that repricing appears to be underway. Whether it continues in a steady grind or accelerates into something more dramatic depends on variables that no one can fully predict. But the direction, at least for now, seems clear. The deficit continues, the inventories shrink. The demand grows, and somewhere, quietly, the mathematics of supply and demand are preparing their verdict. In the end, the silver deficit of 2026 is not really about silver at all. It is about what happens when industrial civilization requires more of something than exists. It is about the limits of price as an allocation mechanism. It is about the quiet competition between nations for resources they cannot manufacture and cannot substitute. These dynamics were always present, but they were obscured during decades of globalization and cheap capital and abundant supply. Now, as those conditions recede, the underlying constraints are becoming visible again. Silver is simply the metal where those constraints happen to be most acute at this particular moment. But the pattern will repeat in lithium, in copper, in gallium and germanium, and a dozen other elements that most people have never heard of, but that modern technology cannot function without. The system is not broken. It is working exactly as designed. It allocates scarce resources to those who pay the most. The only question is whether you understand the system well enough to anticipate where scarcity will strike next. Those who do will prosper. Those who do not will wonder, after the fact, why no one warned them. But of course, someone did warn them. The data was always there. The trends were always visible. The deficit was announced publicly every single year. It just was not loud enough for most people to hear.